As of right now, Tuesday, May 5th, 2026, the market is currently open, and Navitas Semiconductor, trading under the ticker NVTS, is seeing significant activity ahead of its high-stakes earnings report later today. The live intraday price for Navitas Semiconductor is currently $16.58, representing a recovery of 4.15% from yesterday's volatile close of $15.92 on May 4. This morning's price action is a classic example of the tension between market expectations and the cold, hard reality of the semiconductor supply chain. While most investors are watching the price fluctuate on their Robinhood or SoFi Invest apps, expecting a simple pre-earnings run-up, the reality is far more complex. The options market is currently pricing in a massive double-digit move, and the heavy volume we are seeing on interactive brokers trading platforms suggests that institutional players are repositioning themselves for a pivot that many retail traders haven't fully grasped yet. The expectation from the general public is that Navitas is just another small-cap chip play riding the coattails of NVIDIA stock, but the reality I'm seeing in the order flow and the latest sector data suggests a total decoupling. While larger players like Apple stock or Tesla stock deal with massive consumer demand fluctuations, Navitas is carving out a niche in the physical infrastructure of the AI world that most people ignore. Everyone talks about the GPUs, but no one talks about the power delivery systems required to keep those GPUs from melting. This is where the curiosity loop begins. Navitas is no longer just a fast charger company for your phone. They have shifted their entire weight into 800V GaN and SiC solutions for AI data centers. If you're using self-investing tools or managing an individual brokerage account, you need to understand that the volatility you're seeing today isn't just noise before earnings. It is the market trying to value a company that is essentially rebuilding its entire business model in real time. Looking at the intraday swings, we saw a low of $15.82 and a high of $18 just in the last session. That kind of movement is enough to make any user of the Fidelity mobile app sweat, but it highlights the speculative fever surrounding gallium nitride technology. The reality is that while the consensus revenue estimate is pegged at a modest $8.1 million for this quarter, a steep year-over-year drop, the stock has been trading as if it's already a multi-billion-dollar powerhouse. This creates a dangerous gap between expectation and reality. Investors are buying the future promise of AI data center power while ignoring the current loss of 5 cents per share. When you look at the Schwab Intelligent Portfolios or other automated investing sites, these systems often struggle with high beta names like NVTS because the technicals and fundamentals are currently at war. The stock holds a sell signal from short-term moving averages, but a buy signal from long-term ones. It is a tug-of-war that defines the current state of online investing in the semiconductor space. Navitas Semiconductor operates in a space that is vital yet often misunderstood. They specialize in wide bandgap semiconductors, specifically gallium nitride and silicon carbide. In plain English, these materials allow power electronics to run cooler, faster, and in much smaller packages than traditional silicon. Think about the massive power requirements of an AI cluster. If you can reduce the energy lost to heat by even 10%, you save data center operators millions in cooling costs. This is the value proposition that has driven the stock up over 110% in just a few months. However, the reality check comes when we look at the valuation. Trading at over 100 times forward revenue, the stock is priced for perfection. Any slight miss in the guidance provided during the earnings call tonight could send shares tumbling back toward the support level at $15.33, or even lower to the long-term average near $11.67. Before we go further into the future catalysts, I want to hear from you. Comment below how many shares of Navitas Semiconductor you currently hold, or if you're staying away until after the earnings volatility settles down. The broader context of the market cannot be ignored here. We've seen a historic winning streak in the Philadelphia Semiconductor Index, which has provided a massive tailwind for names like NVTS. But when the tide turns, the most overextended names are the first to get hit. We saw a glimpse of this on April 28th when the stock tumbled over 17% in a single day after reports surfaced that certain AI targets were being met across the sector. This is the risk of online stock trading in high-growth niches. You aren't just betting on the company, you're betting on the collective sentiment of the entire AI ecosystem. Many traders using the Interactive Brokers platform are watching the short interest closely, as nearly 25% of the float is currently sold short. This means any positive surprise in tonight's report could trigger a massive short squeeze, potentially pushing the price toward that ambitious $20 price target recently set by analysts at Baird. The transition of their manufacturing from TSMC to Global Foundries is another reality factor that the expectations crowd is overlooking. This move is designed to secure the supply chain and improve margins, but transitions are rarely seamless.
If you were doing your own investment help research, keep a close eye on their commentary regarding their 10-kilowatt DC-DC platform. This is the product that is supposed to win over the big data center clients. If they announce a major partnership with a Tier 1 cloud provider, the current valuation might actually start to look reasonable. But if they only talk about sampling and evaluations, the market might lose patience. This is the core of the storytelling psychology in the market right now. The expectation is a rapid takeover of the data center power market. The reality is a long, expensive qualification process with conservative enterprise customers. When you look at the business from a holistic perspective, you see a company that has successfully pivoted away from the low-margin mobile market. A few years ago, Navitas was all about making your phone charge faster. Today, they are talking about electric vehicle powertrains and grid infrastructure. This is a much larger total addressable market, estimated to be around $3.5 billion by 2030. But a large market doesn't guarantee profit. The company still struggles with profitability, which is why those using Fidelity investments or Fidelity mutual funds might see this as too risky for a core holding. It's a classic moonshot play that requires a high tolerance for drawdown. The financial strength is there with a solid balance sheet, but the profitability is a glaring weak spot that shorts love to target. In the coming months, the catalysts are clear. We need to see the revenue decline bottom out and the sequential growth begin. The company has promised that 2026 will be the year of the turnaround, where the high-power markets finally become the primary revenue driver. If the reality of their Q1 numbers show that this transition is ahead of schedule, the stock could easily break through its 52-week high of $19.79. On the flip side, if the macroeconomic pressures on the EV sector continue to weigh on their silicon carbide business, we could see a stagnation period. Tesla stock's performance often acts as a leading indicator for the SiC market, and any weakness there tends to bleed over into Navitas. This interconnectedness is why professional trading platforms like Interactive Brokers are so essential for keeping track of these correlations. As we look toward the end of the year, the opportunities for Navitas lie in the continued electrification of everything. From 5G base stations to military-grade power supplies, the demand for more efficient chips isn't going away. The risk is simply the price you pay for that growth. Is Navitas worth $17, or is it closer to its intrinsic value of $3.39 as some valuation models suggest? The truth usually lies somewhere in the middle. For those using the Robinhood app or other investing sites, the temptation to buy the dip is strong. But in a pre-earnings environment, the dip can quickly become a cliff. The authority in this analysis comes from looking past the hype of the AI power play label and seeing the mechanical realities of the semiconductor industry. To wrap this up, the contrast between expectations and reality for Navitas Semiconductor has never been sharper. The expectation is a high-flying tech darling that will power the next decade of AI growth. The reality is a company in the middle of a difficult and expensive transition, facing stiff competition from volume leaders and dealing with a market that has very little patience for missed targets. The live price of $16.58 reflects a market that is cautiously optimistic, but ready to bolt at the first sign of trouble. Whether you are using Fidelity Brokers or SoFi Active Investing, the strategy here has to be one of cautious observation. The insights we've covered, from the short interest pressure to the data center pivot, suggest that the next 24 hours will be some of the most important in the company's history. We've seen the expectations. Tonight, we finally get the reality. Stay sharp, watch the volume, and remember that in the world of semiconductors, the smallest details in a power system can make the biggest difference in a portfolio.